The first major lesson from a random walk down Wall Street is that financial markets are mostly efficient. This means that prices of stocks, bonds, or any traded asset usually reflect all the known information at any given time. If new information appears, the market reacts quickly, adjusting prices almost immediately. This idea forms the basis of what's called the efficient market hypothesis, EMH. Let's say a company just announced record profits. In an efficient market, the price of its stock would jump right after the announcement because everyone would want to buy shares. But here's the key. By the time you hear the news and try to act, the price already reflects that good news. This is why beating the market is so hard. You're not competing with just a few investors. You're competing with millions, including professional analysts, algorithms, and trading firms that act in milliseconds. Malkiel explains that most attempts to find undervalued or overvalued stocks don't work in the long run. Why? Because if a stock were truly undervalued, investors would rush to buy it, and its price would rise until it was fairly valued again. The same goes for overvalued stocks. The market corrects itself through this constant activity. This doesn't mean that the market is perfect. Mistakes happen. Prices can go too high or too low, especially in the short term. But over time, markets tend to correct those errors quickly. That's why it's nearly impossible to consistently outperform the market through picking stocks or timing trades. Even highly paid fund managers with advanced research often fail to do better than the market average, especially after fees are included. This lesson has huge implications for everyday investors. If most people, including professionals, can't beat the market consistently, then trying to pick the next big stock is more like gambling than investing. It might work once or twice, but it's not a reliable strategy. Instead, Malkiel encourages investors to accept that they can't predict prices and focus on what they can control, like minimizing fees, staying invested, and spreading risk. This is why he strongly supports index funds, which simply try to match the market rather than beat it. Index funds don't try to guess which stock will go up. They buy a little bit of everything and hold on. And surprisingly, this simple method tends to outperform most professional fund managers. The efficient market idea also teaches a valuable mindset. Don't get overconfident. Many people think they're smarter than the market because they've picked a few winning stocks. But luck plays a big role. The market is full of noise, and it's easy to confuse short-term success with skill. Over time, consistently making the right calls becomes almost impossible. The second key lesson from a random walk down Wall Street is called the random walk theory. It's a simple but powerful idea. Stock prices move in an unpredictable way, much like a random walk. In other words, what a stock did yesterday tells you almost nothing about what it will do tomorrow. Each step is independent of the last. No clear pattern exists, even if it sometimes looks like one. To understand this better, imagine flipping a coin. If you flip heads 5 times in a row, it doesn't make tails more likely on the next flip. Each result is still completely random. Malkiel argues that the stock market works in a similar way. Prices may go up or down, but there's no reliable method to forecast the next move based on past behavior alone. Many people believe they can see patterns in the market. They use charts, technical indicators, or trends to predict future prices. But according to Malkiel, these patterns are mostly illusions. The human brain naturally looks for order, even in randomness. Just because a stock went up 3 days in a row doesn't mean it's due for a drop, or that it will continue rising. The market doesn't follow those kinds of predictable rules. Malkiel supports this idea with studies and experiments. In one famous example, he had a computer generate completely random stock movements, and when shown to analysts, many believed they were looking at real market charts. This shows how easy it is to see trends where none exist. The random walk theory challenges both technical analysis, studying charts, and fundamental analysis, studying company data to estimate value. While fundamentals can tell you about a company's health, Malkiel explains that most of that information is already built into the current price. Unless you have unique, non-public information, which would be illegal to trade on, it's nearly impossible to gain an edge. This lesson also explains why short-term trading often fails. If price movements are random, then betting on daily or weekly changes is more about luck than skill. A trader might succeed for a while, but over time, luck runs out. Consistent success in a random system is extremely rare. The randomness of the market doesn't mean you can't make money. It just means you have to approach investing differently. Instead of trying to predict short-term movements, focus on the long-term growth of the market as a whole. Over decades, the stock market tends to rise because companies grow, economies expand, and innovation drives progress. But on any given day or month, anything can happen. This lesson leads back to one of Malkiel's core ideas. Don't try to outguess the market. Accept that you can't predict it. Another takeaway is to ignore market noise. News headlines, expert opinions, and short-term movements often stir emotions, but they don't offer useful guidance. If price changes are mostly random, reacting to them with fear or excitement can lead to bad decisions. The third major lesson is the power of indexing. Indexing means investing in a broad market index, like the S&P 500, instead of trying to choose individual stocks or time the market. To understand this, you first need to know what an index fund does. An index fund is a type of mutual fund or exchange-traded fund, ETF, that mirrors the performance of a market index. For example, an S&P 500 index fund buys shares in the 500 largest publicly traded companies in the U.S. in the same proportion as the index. The goal is not to beat the market, but to match it. This approach is powerful for several reasons. 1. Most active funds underperform the market. Many people believe that expert fund managers can deliver better returns by picking winning stocks. But Malkiel presents decades of evidence showing that most actively managed funds fail to beat the market, especially over the long term. Even when a few managers outperform one year, they rarely repeat that performance. It's not just hard to beat the market, it's almost impossible to do it consistently. 2. Lower costs equals higher returns. Active funds usually charge higher fees for management, research, and trading. These costs eat into your returns. Index funds, on the other hand, are inexpensive to run because they don't require constant buying and selling or teams of analysts. Their lower fees leave more money in your account, and over time, this makes a huge difference. For example, imagine two investors earn the same gross return of 8% per year. One pays a 1.5% management fee, while the other pays only 0.1%. After 30 years, the low-fee investor will have tens of thousands of dollars more, simply by paying less in fees. 3. No need to predict winners. Picking individual stocks requires predicting the future, which companies will grow, which will fail, and how the market will react to news. This is incredibly difficult, even for professionals. With indexing, you don't need to guess. You own a piece of the whole market. As companies rise and fall, the index adjusts automatically, always reflecting the current market landscape. Malkiel doesn't just recommend indexing because it's simple. He recommends it because it's backed by data. Year after year, index funds outperform most active strategies, and the longer the time period, the clearer the advantage becomes. The fourth key lesson is that time in the market is far more important than trying to time the market. In simple terms, staying invested over a long period brings better results than trying to guess when to buy and sell. Many investors believe they can earn more money by jumping in when prices are low and jumping out before they fall. This strategy is called market timing. Buy low, sell high, but in reality, it rarely works. Why? Because it requires two accurate predictions: when to get out and when to get back in. Even professionals struggle to do that consistently. Markets are unpredictable. News events, economic shifts, investor emotions, and random shocks all influence prices. Often, the market moves sharply in very short periods. If you're not invested during those brief windows, you miss the biggest gains. A few strong days can make up a large portion of yearly returns. Missing them can drag your performance down significantly. For example, studies show that if you stayed fully invested in the S&P 500 for 20 years, you might earn around 8 to 9% per year. But if you missed just the 10 best days, your return could drop by half. If you missed the 20 best days, your returns might fall close to zero. These top-performing days are impossible to predict, and they often occur during times of high uncertainty, right after a crash or during a recovery. Most people are too afraid to invest during those times, which causes them to miss out. Burton Malkiel emphasizes that the best results come from staying in the market, not trying to time it. When investors panic during a downturn and pull out their money, they often miss the rebound. Likewise, trying to wait for the perfect time to enter the market usually leads to missed opportunities. There's always a reason to worry: inflation, recessions, wars. But despite those fears, the market has consistently grown over the long term. He encourages investors to develop a strategy and stick with it, even during downturns. History shows that markets recover from crashes. The Great Depression, the dot-com bust, the 2008 financial crisis, and the COVID-19 crash all caused panic. But in each case, the market eventually recovered and reached new highs. Those who stayed invested were rewarded. Those who tried to time the ups and downs often lost more money or gave up gains. Malkiel also warns against reacting emotionally. When prices drop, fear causes people to sell. When prices rise, greed tempts them to chase returns. These emotional reactions lead to bad timing decisions. Let's take an example. Suppose two investors each invest $10,000. One stays invested for 30 years and earns a steady 8% return. The other tries to time the market, often pulling money out during downturns and missing key recovery periods. As a result, they only earn 5% on average. After 30 years, the first investor ends up with nearly $100,000, while the second has around $43,000, less than half. The difference comes entirely from staying invested and letting compound growth do its work. In short, time is your strongest ally in investing. The fifth lesson is that risk and return are inseparable. In investing, the possibility of earning higher returns always comes with greater risk. You can't get one without the other. The more return you expect, the more uncertainty and volatility you must accept. Burton Malkiel explains that many people want the best of both worlds, high returns with little or no risk, but this is not how markets operate. There's a clear relationship between the amount of risk an investor takes and the potential reward. Assets that are relatively safe, like U.S. Treasury bonds, offer low but stable returns. Stocks, on the other hand, offer much higher long-term returns, but they come with wide short-term price swings. To illustrate this, Malkiel walks through historical data. Over the past century, the stock market has provided an average annual return of about 8 to 10%. Bonds have returned about 3 to 5%. Savings accounts return even less, often barely keeping up with inflation. Why do stocks return more? Because investors need to be compensated for taking on more uncertainty. Stock prices can fall sharply in recessions, crashes, or during global events, sometimes for months or years. If there were no risk, everyone would buy stocks and returns would shrink. The reward is linked directly to the willingness to bear risk. Malkiel also introduces the concept of standard deviation as a way to measure risk. A stock or fund with a high standard deviation has large price swings. It can go up or down sharply. A bond or fund with a low standard deviation moves more steadily. When you look at two investments with similar average returns but different standard deviations, the one with lower volatility is safer. However, lower volatility usually means lower return too. He also highlights a crucial point. Not all risk leads to reward. Taking on more risk doesn't guarantee higher returns. It only increases the possibility of higher returns and the possibility of larger losses. So smart investing means choosing risks that are likely to be rewarded, not just chasing high-risk opportunities. This leads to the idea of the risk-return trade-off. Every investor must decide how much risk they're willing to take based on their goals, time horizon, and ability to handle market downturns. A young investor saving for retirement can afford to take more risk because they have decades to recover from market drops. A retiree, depending on their savings, needs more stability, so they might favor bonds or dividend-paying stocks. Another most important lesson Malkiel teaches is that how you divide your money among different asset classes, not the specific stocks you pick, has the greatest impact on your long-term results. Many investors focus too much on picking individual stocks or timing their entry points. But research shows that the majority of your portfolio's performance is driven by asset allocation, the mix of investments like stocks, bonds, real estate, and cash. Choosing whether to invest in tech stocks or energy companies matters far less than deciding how much of your total portfolio should be in stocks versus bonds in the first place. Why is asset allocation so powerful? Because each asset class has a different risk and return profile, and they don't all move in the same direction at the same time. Stocks generally offer higher returns over the long term but come with greater volatility. Bonds are more stable but offer lower returns. Real estate adds diversity and cash adds safety. By blending them, you reduce the risk of one bad investment wiping out your gains while smoothing out your overall returns. Malkiel emphasizes that your age, risk tolerance, time horizon, and financial goals should guide your allocation. A young investor saving for retirement might invest 80 to 90% in stocks and the rest in bonds or cash. Someone near retirement might reverse that ratio, putting more into safer assets. The key is that your allocation should reflect your ability to take on risk, not your desire for fast gains. He also warns against overconcentration. Putting too much money in one sector, like tech, or one region, like U.S. stocks only, can increase your exposure to unpredictable events. A better approach is global diversification, including international stocks and bonds, which adds more balance and reduces reliance on the performance of any single country or market. Rebalancing is another key idea tied to asset allocation. Over time, some investments grow faster than others and change your original mix. If you started with 70% stocks and 30% bonds, but after a few years, stocks now make up 85%, your portfolio has become riskier than you intended. Rebalancing means adjusting back to your target mix, selling a bit of what has grown, and buying more of what has lagged. This helps maintain discipline, reduce emotional decision-making, and lock in gains from outperforming assets. Malkiel makes it clear, you don't have to predict which asset class will perform best each year. You just need to have a smart, diversified allocation and stick with it. History shows that no asset class wins every year. Sometimes bonds outperform stocks. Other times real estate shines. Instead of chasing trends, disciplined allocation ensures you always have some exposure to what's working, while protecting you from major losses in what's not. Burton Malkiel explains that one of the greatest threats to your investment success is not the market, it's your own behavior. Human psychology often pushes investors to make poor decisions at the worst possible times. Understanding and avoiding these common behavioral biases is essential for long-term success. First is the herd mentality. When markets are booming and everyone seems to be getting rich on a hot stock or a rising sector, it's tempting to jump in, not because of logic, but out of fear of missing out. Similarly, when markets crash, many panic and sell everything to avoid further losses, even if nothing fundamental has changed in their long-term goals. This behavior leads people to buy high and sell low, which is the opposite of what successful investing requires. Second is overconfidence. Many investors believe they can outsmart the market, picking the right stocks, timing the perfect entry, or spotting trends before others do. But Malkiel presents research showing that overconfident investors trade more frequently, underperform market indexes, and often underestimate the risk they're taking. Thinking you know more than the market leads to excessive risk-taking and disappointing returns. Third is loss aversion. Psychological studies show that people feel the pain of a loss twice as strongly as they enjoy a gain of the same size. This causes investors to hold on to losing stocks too long, hoping they'll bounce back, or to sell winning stocks too early just to lock in gains. Both behaviors hurt overall performance. Sometimes, the best move is to accept a loss and rebalance, but emotion gets in the way. Another powerful force is recency bias, the tendency to believe that whatever just happened will continue. If the market had a strong year, people assume it'll keep going. If a crash just occurred, they believe the worst is ahead. This leads to bad timing decisions. Malkiel shows that reacting to recent news instead of long-term fundamentals is one of the main reasons investors underperform. Then there's confirmation bias, where investors seek out information that supports what they already believe and ignore data that contradicts it. For example, someone convinced that tech stocks will explode might ignore signs of overvaluation. This tunnel vision creates risk and blocks rational thinking. What's Malkiel's solution? He urges investors to recognize these behavioral traps and build systems that protect them from themselves. That includes automated investing. Regular contributions to a diversified portfolio remove emotion from the process. Rebalancing schedules. A predefined plan to rebalance helps avoid panic decisions. Long-term mindset. Focusing on decades, not days, reduces the temptation to react emotionally. Index investing. Passive strategies require fewer decisions, which limits the chances of behavioral mistakes. In summary, your own brain can be your worst financial enemy. Recognizing that is not a weakness, it's a strength. By understanding and managing emotional triggers, you gain a real edge in the market. Malkiel's advice is clear. Remove guesswork, limit decisions, and stay the course. That's how wealth is built.